Let's continue the conversation with Dennis Lockhart, joining us, the former president and CEO of the Federal Reserve Bank of Atlanta. Dennis, welcome back to the Schwab Network. Always appreciate you being here, too.
Thank you. Thank you. Good to be with you.
Let's start kind of with the commentary there, because the first 10 minutes of the Q&A and Powell's testimony seemed to repeatedly intimate that he wasn't going in March, but he didn't say that. And then about halfway through the conference, he just said, look, we're not likely to go in March. I thought that was kind of a unique degree of explicitness from him. What do you think?
Yeah, I agree. I thought he would tiptoe a little bit more than he did and keep all his options open and, try to perhaps subtly reinforce some of his earlier messages. But when asked the question, he said it's not our base case.
So
going in March.
Do you think that he endangers the economy at all? I mean, if we believe the bond market at face value these last couple of weeks, and literally up until he said that moment, it seemed like they were worried about either economy rolling over or that he's going to keep things too tight. What's your interpretation?
Boy, I mean, it's really hard to draw that conclusion given all the data that have come in recently. We've got strong growth, call it top line growth in the economy. We've got disinflation, very clear disinflation. And we'll find out more on Friday, of course, but we have a very solid employment picture. And nothing seems to have arisen that really casts big doubt on that continuing for a while. So at least relatively near term, it's very hard for me to see a dip or a strong turn into a recessionary or difficult economy, short of some shock. There are a lot of things going on in the world that could produce a shock, but the economy itself seems to be on a very good track.
To that point, strangely enough, unless I missed something since the show started, I haven't heard anybody ask him about the regional bank situation today. It seems to be one company, but it has hit the whole sector. And last year, there were emergency measures that had to be put in place, and some of those are set to roll off. So if you were in Powell's shoes and I asked you what you're thinking about regional banks and the financial system as a whole, what would you say?
Well, I think there is concern about commercial real estate, particularly the office sector of commercial real estate and how that's going to play out. Many banks are regional and small banks or community banks are pretty highly exposed to that sector. But one thing, I thought your earlier speaker really made a very good point, and I'll interpret what he said. The bankers have not been asleep since Silicon Valley Bank. They have been trying to adjust their balance sheets, trying to strengthen their capital ratios, and they have been relatively careful regarding credit. So they're probably in a somewhat better position today than almost a year ago when we had the Silicon Valley Bank thing take place. That said, commercial real estate and embedded losses in long duration bonds could be a problem, but I think the situation is probably better today. And that's probably the message that Powell is getting from his supervision and regulation people.
Do you think Powell and team watch the yield curve attentively? Are they believers of it as a signal? Certainly it has widened out substantially, but kind of through an unconventional way with long bond yields rising over the last 6 months. So do you find that to be encouraging, or do you find that to be potentially a risk of a reflation style event?
I think they're pretty happy with where the market is today, with the 10-year around 4%, a little below, a little above, but basically fairly close to the 4%. If I were in their shoes, I'd be reasonably satisfied with that. When the 10-year was approaching 5%, I think that might have raised some concerns, but around 4%, pretty good. I think the yield curve hasn't been a very good predictor for the last year or so, maybe more. So I don't think they're overly concerned about inversion or disinversion or de-inversion. And from my experience of having been on the committee, there's only so much they can do. They just have to set policy and let the markets react and take care of themselves.
I think one of the most important things that Powell said this afternoon was his description of the forces behind disinflation. Basically, his justification for not cutting seemed to be, well, we're happy with the direction it's going, but we know a lot of it's come from the supply chain. We might have had something to do with that along the way. Maybe not. What have you learned here about what role the Fed and what power it really has compared to just kind of the natural forces coming out of COVID?
Well, I think this episode has taught us that there are many kinds of inflation or many flavors of inflation, and sometimes they're caused by things that are not, strictly speaking, monetary in nature. And then when you're trying to get inflation down, it helps to have, in this particular case at least, it helps to have a lot of assistance from the supply side, which is certainly a meaningful factor. Having said that, monetary policy is not impotent and very clearly has had an effect. But as Powell pointed out, it's a joint story.
It seems like he wants to see more disinflation from services, from consumers. But we as Americans, boy, we are still swiping like crazy. Dennis, are you confident that we will see that next leg lower in services side of consumer inflation, or is this going to be a harder mile to close?
I think the employer cost index report this morning and other indicators suggest that we're seeing a gradual softening, if you will, of wage gains, which would be an important factor on the services side of the consumption of the United States. So I think they're pretty confident when they see the wage deceleration, and when they see the labor market getting back into greater balance, that they will see the impact on services inflation. And the overall picture for inflation is pretty encouraging. I thought today's press conference was interesting in the sense that he didn't naysay any of the assumptions out there. He just said we want to see more of it.
Yeah, seems like he's okay with kind of the vector, the trajectory, just wants it to lengthen out a little bit more. Fair description?
Exactly. Yeah, I think that's a fair description. I do think central bankers tend to be very cautious. They don't want to have a reversal of policy, so they don't want to be put in a situation where they, are going to be viewed as having made a mistake of some kind. So they tend to be a little slower to act than market anticipation of their acting.
Understood. Dennis, thanks for putting us on your schedule today. Good stuff.
Thank you.
Absolutely. Dennis Lockhart, former president and CEO at the Federal Reserve Bank of Atlanta.